Welcome back, everyone. Instagram Live.
We're live. Can I sit like? Is it weird?
No, it's not.
I mean, when you get on a couch, what's your first reaction?
It's whatever feels good for you. Gas prices are down. On another note, it's like $5.19. That used to be like $6 over there, right?
I don't know.
But you don't know. He has a Tesla. He doesn't go to the gas station. He goes to the Tesla station. But anyways, in other news,
State of the market.
State of the market, oil prices, gas prices, Tesla, it's all part of the market. But state of the market in terms of the Goldfinger Group, real estate investments, Southern California apartments, that's what we do. It's actually funny, my brother Yoshi today was asking me about some sort of like tax questions, like tax deadlines coming up.
Went to the wrong Goldfinger.
So that's what I told him. I said I'm not a credible. I said you have a grandfather who's a CPA, my brother's a CPA. And you can't be asking me these kinds of things. So we'll talk about what we do know, and that's that's kind of like this much. But for everything else, go to your credible sources. We will talk to you about the real estate market within Southern California, and there's been a lot going on from interest rates, rents, construction costs, and then other just sentiments going on in the macro economy related to jobs, growth, recession fears, inflation. A lot to touch on, and Max is gonna do all the talking.
I'll do it all from here. What's actually pretty cool, so we're in our office. This is one of our corner offices that we're actually leaving pretty soon, looking to go to Santa Monica or Mar Vista or Playa. But right here is the West Side Pavilion that Google took over, and it's been pretty cool. We've been here for 2 years, and the progress that they've made, I think, I don't know, talking about state of the market, like where a lot of these companies are with hybrid, back in office, work from home. I know some of these tech companies are 1 to 2 days in the office, 3 days at home. So it'll be interesting to see kind of what happens in this area with the pavilion, with Google employees coming in. And then also, we're so close to Mar Vista, we're so close to Palms, we're really close to West LA. So these rental markets, as you have thousands of Google employees that, even if they're hybrid and they have to go in the office 2 days a week, they probably still want to be in these nice West Side locations. So we'll definitely see what happens here. But in terms of what's going on today, as you said, I think the two big things that we're seeing right now, I guess there's kind of three. There's interest rates, construction costs, and transaction volume. We'll talk about interest rates first. We've probably said this a couple times. We refinanced properties back in March and we were getting 3.4% interest. We refinanced properties in June, July, we were getting 4.5% interest. And now we're doing new purchases. We're under contract to buy a property on the west side. Our loan broker told us, hey, most likely 5%, but we're gonna underwrite to 5.25 because treasuries were up 14 basis points just today alone, which is pretty crazy, and I think that's affecting the market.
Absolutely. And one other thing, aside from the interest rates, construction costs, and market activity, meaning people buying and selling, the other thing is rents. And we haven't seen much of a dip in the rental market, but I think that we've seen within our own portfolio, the last couple of units that we've leased out, it's taken a long time to get the rents that we wanted. And so we've kind of had to make a calculus of, do we let the unit sit for a little bit longer and keep trying to hit the rent, or do we just bite the bullet and give a reduction and get it leased out quicker? And for us, a lot of that comes down to, are we looking to hold this asset for the next 10 years, or is this a property that we're priming to sell and that we want to hit a certain income on the property, in which case it makes sense to let the unit sit on the rental market for another month or two until we hit that market rent. Given that a lot of the properties that we've stabilized, we're probably going to hold on to for the long term, we've decided to either give concessions to those units or drop the price so that we can fill the units and increase our cash flow, because that's what we've decided to do for those properties. But I think, just speaking to the market at large, when you're seeing units sit on the market longer to get those market rents, it means that there's less demand, and it also many times is an indication of what we're going to see on other units in the next couple of months in terms of people, the desirability to live in certain pockets of LA.
And I think part of that is, rents came down so much. Vacancy was it wasn't higher, but I think because people left LA during the pandemic, there was less demand, so prices and rents came down. And then we saw a rapid increase, crazy increase. But I think what it was is that we made up for the drop in rents for about 18 months. And then plus the increases that we should have saw in the rental growth that we should have saw. So we saw a rapid increase in the rents, and I think it's kind of tapering off. We're not seeing that same growth. There is a little bit of seasonality, right? We're at the end of summer.
True.
Students are back in school. People were traveling at the end of summer, so there is seasonality. But yeah, I agree. I think we may not see such a drop in rents, but I think this tapering off and then seeing where are we going to land? Where is it going to stabilize to? And I think that's where we're at today.
We're certainly not underwriting for any rental growth. When we're looking to buy properties, we're not assuming that rents are going up in the next year. So based on what we're seeing in terms of market, market activity and people's sentiments, that's the word I was looking for, sentiment. The sentiment that we're seeing in the market, I would say that most people that we're talking to have confidence that the market is not going up. Okay, and many people are predicting a recession, a drop in the market within the next 6 months. Okay, it could be 6 months, could be 12 months, could be 3 months, but within the next around 6 months, there are a lot of people, a lot of credible sources that we talked about, credible sources that are anticipating a recession, a drop in the market, and some people believe that things will stay flat. I've never been really good at predicting the market, so I'm not going to try to do that. But what we do when we're looking to buy a property is we look at where things are today, where they're trending, and we do our underwriting very conservatively. So we look at what we can get for rents today, and even if we're looking at an 18-month reposition on the property and we think we're going to be leasing out the units 18 months from now, we're not going to bake in any rental growth. We're going to say, what can we rent the units for now? And that's how we underwrite our properties. In terms of our underwriting for interest rates, like you said, around 5.25%, we could probably still snag 5% money today. And then on the exit, when we're looking to either sell or refi in 18, 24 months, we're looking probably around 6% cap rates.
Kind of like just above interest rate, because the way you got to look at it is you got to be above a break even on your debt.
Which is making deals harder to pencil, right?
And I think that's why transaction volume is so slow, is you have sellers that saw buildings trade 6 months ago that say, well, I want that pricing, but that's when buyers like us were getting 4.5% debt. And now that the cost of money, we did talk about interest rates and the impact, and when your cost of borrowing money, your cost of capital goes up 30-40%, the prices have to adjust accordingly, because we got to make the same yield on our money. Whether we're borrowing at 2% or 10%, it doesn't really matter. We got to make the same spread on the money that we're placing into these assets. So if we're paying more for our debt, that means we have to get it at a lower price, and I just don't think sellers are there yet.
There are obviously certain sellers that need to sell. They have certain life cycle motivations, the 7 Ds: death, divorce, disease, dissolution, deferred maintenance, whatever. There's all the Ds, all the reasons that people decide to sell because of things that are happening in their lives. And those people will essentially be forced to meet the market. Like, if they're really motivated, they're going to meet the market. And the good news is that we're not in a recession now. So if you're looking to sell, you're not going to be getting, bottom of the market pricing. You did miss the top of the market, which was probably 9 months ago. 6-9 months ago, you could have gotten a lot more, but that's how it goes. Sometimes they're better than other times. So for people who have to sell, go ahead, sell. It's not the worst time, not the best time. People who are doing 1031 exchanges, it's the kind of time where 1031 exchanges, you're generally selling and buying within the same general market period. Now, you could get screwed and you sell and then prices all of a sudden take off. I don't think anyone, in terms of go up, so you sold here and then the market goes here, makes it more difficult to buy. I don't think anyone is really predicting that big of a jump in the market. So I think it's safe for people who are looking to do 1031 exchanges, that's fine. And then people who are looking for like the most opportune time in the market to sell, I would say it's probably better to wait a couple of years, or at least 6 months to kind of to see where things are at, and if we're in a recession, or who knows, maybe we're maybe the market jumps up 20%.
Yeah.
Who the hell knows these days?
Yeah, it's hard to know. But I'll tell you what we know is we're still buying 17 units Hollywood, 11 units in Silver Lake. We're under contract to buy a property in West LA. We still have a couple 1031 exchanges. I think we have to buy a minimum of $6 million of property, so we're still on the hunt. And I think, look, we look at different short periods, right? 3 month, 6 month, 9 month periods of what's going on in the market and how we're shifting and where we're headed, where we were. But the truth is, I think we still maintain a long-term optimistic perspective on real estate in LA. I mean, you look at it, it's always appreciated. Maybe it comes down for a little bit of time, rents come down, property values come down, but we're always trending up. And I think it's just because there's a demand for people who want to live here, the jobs are here, people want to be here. So we're going to keep buying, maintaining this conservative approach given what's going on today. But this is where our money is. This is where we're going to continue to buy, own, and operate, and manage our assets.
Yeah. Beach volleyball, tennis, 320 days a year.
It's too good.
Gotta stay here. So anyways, thank you guys for watching. If anyone has any questions, comments, interest in investing with us, any deals for us to look at, please feel free to reach out at the Goldfinger Group, at Yahoo, Maxx at thegoldfingergroup.com. Until next time.
Thanks.